What's up, everybody? The boys are back. Sorry we missed you in June. Too much vacation time. Just kidding, not really. We're going to kick off with our July market update. So jumping right in here, we do want to hit some highlights for the company to give ourselves a little bit of credit. Youngest company to reach the top 10 Scotsman Guide, which is a huge accomplishment for our team. Tribute to Jack and all the team that's not here with us today that work tirelessly every day to make sure our customers are happy and make sure we're deploying cost-effective capital to our clients. And then another big highlight for us, now rated in 2 securitizations, one on the bridge side, one on the DSCR side. Again, just tribute to how we're managing credit, our disciplined approach to the business, and how we continue to maintain steady flows of capital to our capital providers, where you've seen kind of ups and downs in the industry and folks going in and out. Jumping right in, we're going to get into the market update. All our usuals, we're going to start with interest rates, the 2 and the 10, and the spread. JD, bring us home, brother.
Yeah, so not a whole lot to update you guys on here. The spread between the 10 and the 2 remains around 50 basis points, which is healthy when you look at sort of historical spreads between the 2 and the 10. Yield curve remains sort of healthily inverted, so all good signs there. We actually did see the 10-year come in 10 to 15 basis points from CPI print, which I'll touch on the next slide, but nothing really major. I do want to point out that July 30th, the Fed is meeting. Not going to be a rate cut, at least that's what it's looking. But for the next Fed meeting in September, the market's pricing in a 50% chance of 25 basis points. And the market as a whole is thinking by the end of the year, we'll get at least 2 25 basis point cuts. So I just want to highlight, though, that as we learned last September, just because the Fed cuts rates doesn't mean anything's going to happen to the 10-year or your mortgage rate. So it's something to monitor, but I wouldn't count on rates falling quite yet. Yeah, unemployment actually down a tick month over month. So labor market continues to be really strong. CPI had a bit of a mixed print where CPI for June came in higher, but that was negated by month over month core CPI coming in lower, as well as the producer price inflation index, which also came in lower. The net effect there actually was positive, and we saw the 10-year come down like 10 to 15 basis points. So it's good that inflation is staying in check, but to see any sort of real movement, we would need to see a weakening in the labor market to see any sort of material long-term rates come in. So.
Yeah, interesting fun fact on kind of the Fed. Everybody was worried about the Fed making cuts this year with Doge. Obviously, they haven't seen that, but what was interesting, and I forget what podcast I learned this on, was while federal jobs have maintained kind of stagnant, states have been ramping up their employment as it relates to new hires. And if you listen to like United Healthcare, some of these guys, they're starting to make Microsoft, they're all starting to make big cuts. The private sector making cuts, normalization of where they think, their earnings are going to be. And you see states ramping up employees, which I thought was a fun fact that we didn't note here. Bring us to the starting line here.
Yeah, I'll just start by, this is just a chart of the US dollar index. And what we're pointing out here is that the U.S. dollar has had its worst start to a year, first half of the year, since the 1973 oil crisis. It's down 11%. And the reason for that is foreign investors that typically buy U.S. Treasuries have been diversifying a little bit more into other assets like stocks, other currencies, gold, that sort of thing. And a lot of that's been driven by macroeconomic uncertainty, tariffs, uncertainty around Trump and his big, beautiful bill. We saw Moody's downgrade the U.S. Treasury, yep. So that all plays into this.
What do we actually think about the U.S. deficit, right? I think All In did a pretty good job. I don't know if anybody listened to it. You did, yeah. I know. But $36 trillion outstanding, the average weight 3.5% or 3.3%, so $1.2 trillion in kind of interest expense to the U.S. Fast forward to where the 30 years today, higher, could be up to $2 trillion. Doge didn't work on spending, tariffs potentially inflationary, geopolitical risk, big beautiful spend, or big beautiful bill with taxation, again, inflationary. Do we actually see rates going lower? JD, why don't you kick that off, man? That's a lot.
Yeah, I mean, that's a big one. Well, it's interesting that Trump started with shrinking spending to help the deficit, and now it's totally switched to let's outgrow the debt. I don't know how I really feel about that, when you look like historically, that hasn't really worked in a long time.
Yep.
Probably like industrial revolution was maybe the last major increase in productivity that we had as a country to be able to actually grow out of debt, that's substantial. They talked about it, I know, with the internet boom in the late 90s. That didn't really happen the way they thought it would. So I don't know what and meanwhile he's on the sidelines. His family's doing all this stuff with like crypto assets, and he knows Bitcoin will keep surging as long as this inflationary sort of inability, like just spend environments out there.
Yep.
So I don't really know what his plan is. I've kind of lost the pulse a little bit.
It's all predicated, right, on lower short end of the curve, right? He needs the short end of the curve to stimulate growth in order to make his plan work. But he's got an inflationary bill, right? Yeah. He's got tariffs he's got to work through. That could be short-term spike of inflation. So
my question is just though, but then it's like, when his reign ends, then what happens when the next administration comes in?
Yeah, here's a fun fact. We have 400,000 manufacturing jobs open in the United States and nobody's taking it. And if you look at the history of world powers, once they grow out of industrialization into service-based economies, it's hard to go back to the industrialization. So it feels like the U.S. is hanging their heads on both AI growth and infrastructure growth around energy. And then, so as the two big segments that are going to drive growth, and then of course everybody loves housing, got to have housing as the third big sector, and then healthcare. Those seem to be the driving factors. And then I do you nearshore with a 4-year term, or do you not, right? And so, or are you just going to do a workaround for tariffs and assemble somebody else like in India to then mitigate the tariff, which is what China's going to do, or Mexico, which I think they're trying to close the loophole. But that seems more of what we're seeing. But what's your thoughts?
Well, that's my question. It's like, how do you make the call when his term's only 4 years? And so it's like, how do you make the decision? Okay, like let's bet on this and move operations back to the United States, or let's just wait and see, and then see what new administration does and what new trade deals are made, and then maybe it would have been worth it to just keep, operations offshore. So
agreed. I do think it's interesting, the Genius Bill, and we were talking about this morning, with now crypto being the third largest buyer of U.S. Treasuries for that auction demand, which has switched from just foreigns, right, to foreigns, crypto, banks, et cetera. So I think that diversification of Treasury could be really interesting, and that could continue to keep the U.S. dollar pegged as the world currency, the fiat of the world, and kind of lock us in. Right. I think there's a lot of talk about that. And then they're not allowing NVIDIA to sell their new chips that are the highest power to China, because China has far more energy capacity than we do, and so we got to catch up on the energy capacity to be the world's leader in AI. And I think that investment from the street in the U.S., to your point, could be the tailwind that really helps the U.S. grow out of this. All right, let's switch gears here. We've been rambling too much. Let's go to the mortgage rate. I think this is a great slide for people to understand where we're bouncing in the range. So JD, why don't you kick us off?
Yeah, so this is just a look at the 30-year mortgage rate over the last decade. You saw sort of 2016, 2019 sort of bouncing around in the 4 to 5, and we've been stuck since really 2022 in this 6 to 7 range. And so it pegs the question, how long will we bounce in this range? Will it be forever? Will we ever move out of it?
And if you listen to any public earnings calls, right, on the home builders, they will tell you, like, this here is this affordability between the housing prices and this mortgage rate is what's keeping people put. And that you got 2/3 of the United States with a sub 4% mortgage, and those people aren't moving for a 6.5% or 7% mortgage. And so, if you're a smaller developer, smaller builder, smaller flipper, thank God for beautiful build cost seg, so you get your cash maybe faster, but you got to pay attention to this, because the affordability is going to be key for you to move your product on a for sale market.
The only other thing I want to add on this is you saw mortgage rates come down 2018, 2019, and I'm talking like pre-COVID. A lot of that was economic uncertainty, China-U.S. trade war, fear of recession. And it's funny because you hear a lot of the same themes today in the news: economic uncertainty, trade war with Europe and China and whoever, but there's no downward movement in rates. And so that begs the question, maybe maybe the economy is a lot healthier than people are sort of talking about it in the news. And so I think that's just an interesting sidebar. But
Yeah, I mean, I think, and you guys make this point all the time. The capital markets team in general is like, you need wages to catch up to where home prices are, right? And then, or you need some compression in rates to make this happen. And that gap, I think as we pointed out a year ago, is going to close over 5 years, right? It's not going to happen overnight. So we're like 2 years into what could be a 5-year gap to kind of close that in. And then if tariffs come in and make it more inflationary, et cetera, et cetera. So the street hates uncertainty, and I think that's why you're seeing this kind of range where it bounces back and forth. All right. Our big, beautiful Bill. If you are a flipper real estate guy, you're in the money on this one.
yeah, so I thought we'd just point out some of the key provisions for people that are involved in the world of real estate. So lower marginal tax rates, that one's easy. We all love that. This bill is extending 100% bonus depreciation for qualified property. So that's like the immediate expensing of sort of home improvements, which can boost profitability in a project, encourage, investment in a project when maybe you otherwise wouldn't. The qualified business income QBI deduction was raised to 23%. That's a tax reduction for investors holding real estate, particularly in pass-through and like REIT fund structures. So that's positive if you're investing in real estate. New round of qualified opportunity zones. This is to spur some investment in rural areas, giving tax breaks there. Low-income housing credit, spurring investment in low-income housing projects. Revision to REIT asset test. This was to give some REITs more flexibility in the way that they sort of operate. They're allowed to now hold like a higher value of securities on their balance sheet. So this is just giving them a little more flexibility to operate. And then the state and local tax SALT deduction for homeowners was raised to $40,000. This is a big jump up from $10,000. This is particularly beneficial for homeowners in those high tax states that you're talking about, New York, Connecticut, so on. So
California. All right, guys, that wraps up kind of the macro standpoint. What we thought would be fun is, everybody wants to know where we get all this information outside of our research team. Here's 5 kind of podcasts that we listen to as real estate and credit folks that we think are fun. All In gives you kind of a macro and kind of political view and a tech view. Odd Lots is a strictly financial, non-biased, which is really nice. Capital Allocators is going to be more complex CLO kind of structuring. And then Rent Roll and the Walker webcast give you kind of macro specific real estate data. So those are all cool podcasts to listen and plug in. You'll hear us kind of take some of our sound bites from our market update from these guys.
I'm curious, Ryan, which is your favorite? Because you listen to everything.
I do. Yeah, I do. I like Odd Lots is my favorite there. And then I like the Peter Linneman Walker one where, Peter from Morgan gives his macro update. And I think Jay Parsons from Rent Roll, multifamily operator, but I think it's interesting if you're an SFR guy to pay attention where rents are going and kind of the macro on multi. So I think he really does a nice job of blending multi into SFR and kind of where those REITs trade and how they're looking at the world. I think if you're an investor, it makes a lot of sense. Yeah. All right, guys. As always, we're here to support and be a resource. Our capital markets teams, our sales guys are clearly doing a good job outside, kind of being boots on the ground and frontline information. But happy to underwrite a deal. Send it in. You can email Jack Davis at iFund Cities. Awesome, guys. We appreciate the time and attendance. We hope you're having a great time with your family over the summer, and this was helpful. Again, reach out to Jack Davis at iFund Cities if you have questions, and we'll see you back in August. Thank you.
Thank you.